Thank you, everybody, for joining us today with Steve Adamczyk from Varnum Law to talk about fraud in our community associations, which we have some more topics we were talking about before you guys got on today. But Steve, thank you so much for joining us today. I'll let Steve tell you a little bit about his firm, Varnum Law, here located in Southwest Florida.
Great. Thanks, Lauren. Good morning, everyone. I'm Steve Adamczyk. I'm a partner with Varnum. Varnum's it's a national law firm with nearly 200 attorneys, full service for pretty much every area that you may encounter. Our Naples, Florida office is growing, and we have a dedicated practice here just for community associations. And I've been doing community association law myself almost exclusively for about 15 years now, and really enjoy the opportunity to work with Castle and doing these webinars and presentations, and teaching is one of my favorite things. So I appreciate the opportunity.
Everybody likes your teaching. Condo, HOA, HOA.
Yeah.
If you see him in person, we haven't gotten to see you in person in a while, but
I go down the grocery store. I go into the Publix, and someone walk down the aisle and go, "Hey, you're the condo guy."
You are the condo HOA. Yeah. Well, thank you. And if you're not familiar with Castle Group, we are a full service on-site property management company. So if you have full-time on-site management, please feel free to reach out to myself. And we'll be happy to help you. So I am excited about today's conversation because there's lots to talk about, and Steve's got new stuff. So I was asking him questions before, so I'm going to hold them off for the actual presentation. So Steve, I'll let you take it over.
Great. Thanks again, Laura. So we're going to talk today about fraud prevention, and this is also an opportunity. We're going to cover some new legislation as well, mainly applicable to homeowners associations. But we're also going to devote some time to the Corporate Transparency Act, which is not a brand new piece of legislation, but it is going into effect in a couple months, a couple days actually, which will impact every community association in the state, and it's intended to target financial crimes and fraud and money laundering. So that's going to be a dedicated topic that as well we're going to cover. I had my opportunity to receive my MBA a couple of years ago as well. So that opportunity really gave me some insights into financial statements and business practices, which create opportunities for fraud. There's also some incredible resources out there that accountants and CPAs and auditors publish, which are free to the public and provide a lot of great data, some of which we're going to see in Source today as well. We're talking about the statistics. We're going to talk about broadly management company best practices, and of course Laura is welcome to jump in there in terms of what they see and what they do at Castle to maybe adopt some best practices. We're going to touch briefly on insurance and again jump into that new legislation. Also, I'm a big fan of questions and answers. I think interactive teaching discussions are great. So if you have any questions, please instruct to go ahead and jump into that question and answer tab, and we'll get to it.
Perfect.
All right, so I don't typically read from slides, but this is probably the one I will. So what is fraud? So this is a definition from the Association of Certified Fraud Examiners. They put out this publication every 2 years or so, which I'm going to cite a couple times here in the opening slides. It's fraud against a company can be committed either internally by employees, managers, officers, or owners, externally or internally, customers, vendors, or other parties. So effectively, business fraud is really what we're going to be focusing on today, which is theft at the end of the day, theft of your money by people who are involved in the company in some way. Next slide. So the report to the nations is the one that I'm referring to by the Association of Certified Fraud Examiners. And it's important to note that the typical fraud case lasts roughly 14 months before it's detected. And the average loss is $8,300 per month. And this is important because 14 months is longer than most of the terms that you all are serving if you're serving one-year terms. It might be longer than the term of one treasurer. And so you might have a lot of turnover on the board or through certain officers. And it provides opportunities for certain individuals to potentially take advantage of the situation. And so it's just critical to note that these are not usually 2-week one-offs. They're usually planned, slow, systematic. And like all things in life, when we get away with something the first time, we tend to think that we can do it a second and a third time. As I tell my kids every day when they refuse to listen to pretty much everything I say. But ultimately, this is a long process. Next slide, Laura. The median amounts, not the average amount per month, but the median amount of loss per theft case as of 2022 is $117,000. Now, this number is not for community associations. This is for business. So this is going to include corporate America. This is going to include larger organizations that go beyond condominiums and HOAs. I should say personally, I have dealt with a number of cases with community associations where fraud was involved. And literally, the first one we dealt with was about $114,000 over roughly a year to year and a half. And so it fit right in the median statistics. That situation involved a property manager, not Castle, where they kept the signature stamps from the developer. And so the turnover had occurred years earlier, but they kept the signature blocks, literally the stamp of the signature that was provided by the developer to make it easy to sign checks. While they were in control, they just cut themselves checks for about $114,000 over the course of a year and a half, and just stamped the name of the signature on those checks. Next thing you know, a brand new pickup truck, and people are asking questions. But that literally is what happened, and it was about that median amount.
Yep. And that's why we require 2 signatures, and it's done electronically.
Yes, that is on the best practices slide, Laura, because that's a great point. So condominium and homeowners associations are essentially small business. And this slide here is intended to kind of narrow you into where small businesses fall into the mix. The management company size makes a difference. All right, that's also a critical component. And you'll see here that the larger the entity does not necessarily, and actually does not equal larger opportunities for fraud. You see that the organizations with less than 100 employees actually have the greatest median loss and the greatest percent, not the greatest percent of cases, but certainly the greatest amount of loss. Okay, so size in this context does make a difference. And typically I find that the larger the organization, the fewer opportunities there actually are. And we'll talk about a case in a moment that really focuses on a small management firm and how that was a problem for them. But like I said, the case I mentioned before with the signature stamp, that was a larger organization, but ultimately smaller companies tend to have the larger losses. Next slide. This is a slide that kind of tries to draw you into anti-fraud controls. And these are not small business organizations. You'll see some of these anti-fraud controls are not going to be normal for your small condo or HOA or even a medium to large size management firm. But you can see here that when you have these controls, the opportunity for fraud actually is mitigated. And the more controls we have, generally, the more opportunity is squandered and done by the wayside. We can see here that external audit of financial statements is a big one. Right? So ultimately, those of you who waive audits and do the smaller compiled or reviewed or cash receipts and expenditures reports, there's going to be a much greater opportunity there for fraud and for manipulation of documents and files and records than if you have those audits. And why? Because the auditor is trained to test. They're trained to test what you do and how you do it, to look for opportunities for fraud and embezzlement, and that's helpful. Codes of conduct. Many of you try to do this for boards. Many of you try to do this to try to get everyone to agree all the time publicly, and guess what? That never works if you try. But the code of conduct is helpful. There's a thing called heuristics in life where when you commit into writing, you are actually more likely to comply. And so if you do get your board to agree to a very simple code of conduct for financial issues, again, not trying to get people to say, we're going to agree on everything all the time, because they won't agree to that. But if they will agree to some simple and no-brainer financial commitments, the likelihood of them following those commitments when they sign their name to it goes up dramatically. All right, so this is an internal decision-making thing that's just inherent in humans, but when we commit to something, we're more likely to do it. Management certification of financial statements. Obviously, the larger the organization, the more infrastructure, the more likely that you're going to have the ability for those management firms to say these are reflective of your financial records. Okay. Management review. This is a little different because we're not talking about management firms here. We're talking about levels of management in a corporate setting. But obviously, the more people looking at it, the more helpful. Internal audit departments. This is going to be for you, your finance committee. Right? So for those of you organizations who are large enough, you might have a finance committee whose job is just to every month check and run tests on the finances, look at the financial statements, make sure that the invoices that are paid are reflective of the invoices received. that you're going to make sure that the bank account statements are coming directly from the financial institution and maybe not washed. And so these types of having a few of these more important anti-fraud controls can have a drastic impact. The larger the organization, the more likely they are to have them, but also the less likely to have the fraud. So let's take advantage of some of these best practices that we can learn from these larger organizations. And it might be quite helpful in the community association context. Next slide. So this goes back to the brand new pickup truck I was telling you about. All right, who is controlling the accounting and bank records? The studies show that 42% of occupational fraudsters were living beyond their means. All right, just because someone has a new truck doesn't mean they're committing fraud. Let's make that very clear. All right, there's very good principles there not to jump to conclusions and assume. But the reality is that when fraud was present, we did have people living beyond their means. Right? How else are they getting these resources? 26% of fraudsters were experiencing financial difficulties. So I'm not saying that anyone going through financial trouble is committing fraud. I am saying that if you have someone in your organization who is experiencing financial troubles, it is highly or more likely that they have the opportunity and maybe would act on that. And so it's maybe just keeping a conscious mindset of that situation. And again, if you have the finance committee, if you have that organization that's doing those testing, just keep a closer eye, but it certainly does not mean by any stretch of the imagination that something wrong is happening, but it should indicate to you that that might be a flag to keep an eye out for. Next slide. Concealment methods. Concealment methods. This one actually was very surprising to me about how each 5 of these methods actually was pretty prevalent across the board. The greatest one is physical document manipulation. Right, or I'm sorry, creation of physical documents. And what this means is creating dummy invoices. All right, essentially, it's creating dummy invoices to pay or creating dummy financial statements from phantom institutions, right, that don't exist. And so this is where the finance committee or the board or whomever's doing this is, again, testing the invoices to make sure they match who the contract is with and making sure maybe every once in a while checking the corporate records to make sure that that corporation really does exist. Right? Maybe it's once a year you do this, but maybe that's cut short that 14-month window if there's something going on. The alteration of physical documents. Again, this is where you maybe only have mailed copies of contracts or agreements or invoices or checks being sent to one person, and that person has the stamp. Okay, whether it's the physical stamp or the proverbial stamp with whiteout or markers or pens, but the alteration of physical documents, literally maybe adding a 0. Right, or taking away a 0, and finding a way to make the difference in the dollar amounts go to a dummy corporation they create with the fraudulent physical created document and invoice. Okay? 25% from the alteration of electronic documents or files. We're going to talk about this one in a minute with a small case of fraud that not a small case, but a small company that had a very large case of fraud here in Southwest Florida. But the problem there was the ability to get electronic bank statements. Right, and how there's manipulation opportunity there. 23%, the destruction, withholding of physical documents. I think this largely goes with the manipulation of physical or electronic documents, and we'll talk about that more in a second. Next slide.
Yeah, I've got a question that came in, Steve,
Sure.
from Michael. Yeah, he asked, can we force boards to do background financial checks on individuals who want to be a treasurer on executive boards? Great
question. No. Is the short answer. And let me tell you why. 99% of you out there in community associations have engaged management firms to do and have delegated responsibilities for really what the treasurer does. And most communities are not going to have a CPA or someone with financial training to be able to sit in that role. So whether you do the background check or not, it might not mean that you have someone who inherently has the skill set. But the question really pertains to background checks. And it's actually relevant to one of the new statutes, but the statute's also clear that there are only certain things that could be a condition of eligibility to run for the board. And I do not believe that you can make as a condition of eligibility that they consent to do a background check on themselves. Now, ironically, the statute says that if you've been convicted of a felony, then you can't serve on the board until all your civil rights have been restored for at least 5 years. The civil rights are to have a gun, to vote, to serve on a jury, to hold public office. You have to have all those rights restored for at least 5 years. And normally what happens is that the first notice of the election will have a disclaimer on it that says, hey, if you have this problem, you're not eligible to run. But they don't require people to do background checks because I don't think you can do that as a condition of eligibility. What normally happens almost every time I've had this problem is you all Google each other, right? You all eventually run into a spat with one another and you Google each other from their hometown up north. You turn out, oh, Joanne was convicted of embezzlement 10 years ago. That would have been nice to know. Did they have all their civil rights? That's a constant problem. This is also an awesome opportunity that I use in my board certification classes to talk about how kind of deplete of help the statute can be sometimes. I know we once had a president who was a graduate of witness protection. He was an organized crime, and he told me, Steve, in my day, I've committed lots of felonies. I've done lots of bad things, but I've gone through witness protection, and I technically, with my new identity, can serve on a jury. I can have a gun. I can go vote. I don't have a speeding ticket. I'm eligible to do all these things. And so we did our due diligence in the statute that talks about, well, what if you've been actually convicted of these things versus coming through witness protection? So we called the FBI. And guess what? The FBI does not care about your condo election. They told me very clearly to go away and not to ask any more questions. And so they are not interested in the outcome of your condo election. But the takeaway here is that we don't run background checks because it can't be a condition of eligibility. You likely will Google each other. And for felony convictions, it's a flat out ineligibility unless you've had your civil rights restored for 5 years. But as we're going to see in the HOA context, there's also an ineligibility for certain arrests that have to deal with financial crimes. So no to the requirement, but it's obviously a good idea because it's relevant to eligibility and the ability to serve. And what normally happens is you Google each other and you find it out. Good question.
Thank you. I did see someone raise their hand. Just a reminder, you can submit your questions through the Q&A option on your toolbar for Zoom, but we can't have you go live with your audio.
All right, the next slide is going to highlight that case I was telling you about. Out of the blue, some community associations come to us and they say, Steve, we're not sure we have our money anymore. The management company told us they accidentally gave our account money to a different community association. He says they paid it back. We went down to the bank, literally with the Department of the Secretary of State's corporate filing that says who the president is and with the driver's license and saying, I am the president. Let me see my money in the bank account. And the bank said, sorry, can't do that. And so all of a sudden, all these red flags go up. The next thing you know, the next community calls, and you call our colleagues at another firm. We say, are you hearing stuff about this? They're saying, yeah, it turns out I had 4 communities call that all of a sudden can't get their money and maybe there's a problem here. Ended up being in the Southwest Florida news for a while. And all the flags were there, right? You had the general manager, the property manager, who was the CAM, who was the husband. And then you had his wife, who was the controller, who was handling all the finances, doing all the financial reporting. And obviously that marriage relationship creates an opportunity because you don't have an arm's length relationship. Records now show that they had private flights around the world and renting airplanes and living beyond their means. And maybe people weren't seeing it personally, but it was happening. We also had, the wife was going through some health issues, as they allege. And so you obviously see the need as well as the living beyond their means in terms of seeing these troubles on the horizon. And because they were such a small organization, and I'm not saying that small organizations can't have great financial controls, but the fact that it was a smaller organization was indicative here that they didn't have the financial controls. And so that was a big problem. You had checks bouncing, vendors calling and saying, hey, Steve, this management checks companies bounce, 3 different communities I'm working with them on, all of a sudden all of the dominoes start to fall and you start seeing problems. And another kind of tidbit example down there is exactly what I was talking about with the truck. The woman she literally wrote checks to herself and stamped it. For some of those checks. For other checks, she created an LLC for herself, a realty company, and wrote checks to the realty company and stamped the signature of the president, who was the former president, actually. But the signature cards hadn't been changed at the bank. And so the bank deposited them. And so again, there's a problem there. But when you have these flags go up, you need to get ahead of it. And the next slide is going to talk about some of the best practices that I know Castle employs, but it's also worth kind of walking through.
Mhm.
And so segregation of duties. This was a big problem, right? In the smaller case that we had. Multiple approvers, right? Laura talked about having multiple check signers, receipts for credit cards and other purchasers. And Laura, I don't want to put you on the spot, but are there any other kind of, marketing materials that you all talk about with Castle that would be helpful here in terms of what you all do for this?
Yeah, so we've got the 2 signers that have to be board members. At times we'll add a third if somebody's going to be traveling out of the country so that we don't hold up payment. We have segregated duties and departments at our home office. So it's not just one department doing accounts payable, receivable, and all of the above. So that's a good thing. And then again, our name is not on your bank account. It is the association. It's in the association's name with the board members as signers.
Mhm.
That's another big thing that I think happened in that specific incident you're speaking of, is a lot of the associations where the bank accounts were in that management company's name versus the association's name.
Yeah, so we learned a lot about these things called custodial bank accounts through this fraud case, where it turns out that the president went down to the bank and said, "Here's the record. Here's my driver's license. I'm the president." And the bank said, "It's not really your account." And they're like, "But it says so and so HOA on the bank statement." And they said, "Yeah, technically, but it's really in the management company's name as a custodian for you."
Right.
It's kind
There's
of
a
like saying that the bank account is in the name of the trustee. It's like the beneficiary of a trust walk up and say, "I'd like my money now, please." And the bank says, "Well, I know you're the beneficiary, but really it's in the name of the trustee for your benefit. So I can't tell you what's going on." And that's pretty problematic. And as you can imagine, that would scare a lot of people who have fiduciary duties, and this is not just their money. And so what Laura's telling you is actually a fantastic, I would say, asset for what they do, because that's not the case, and it's frustrating for a lot of people. And in that case, what we do insist on people do, if it's even possible, is a redundant bank account statement. And what I mean by that is we talked earlier about the prevalence of fraud by electronic manipulation of documents. And if it's possible, you want to try and work with your financial institution, your bank basically, to ask them if they can send a redundant set of monthly account statements to maybe your treasurer or someone that you appoint. That way, you're taking away an opportunity for manipulation. And if you were to run into the case like we saw with the small management company down here in Southwest Florida, you wouldn't be waiting for months just to figure out what your balance is.
Mm-hmm.
Right? Their problem was they couldn't even figure out if they had a balance in the account. The bank wouldn't even tell them if they had a penny in the bank account.
Yeah, and that's something we definitely will give boards access to, not only our management software, which is GenArc, so they can log in and pull reports at any time, but obviously access to view their bank account.
Mm-hmm. That's a huge asset, I would say, because the custodial nature of the bank accounts is where things are going for a lot of management firms, because there is some efficiencies on their end. But it also, tells the clients that, your money is not really in your name. It's sort of in your name, but it's also in there with a bunch of other communities that we're also custodians for. And that's kind of alarming to people.
Yep.
Approval process defined for banking, investing, and collections. And we talked about segregation of duties. A lot of firms have different people who are in charge of collections and receivables than they are for the payables, which is obviously a really helpful internal control. With now the interest rates are going up a little bit, we're seeing people kind of go back to some traditional investment options. But a couple of years ago, when interest rates were so low, we had people asking, well, can we get creative? And the statute doesn't say you must invest in minimal interest, zero risk account securities, but the statute does impose on you a fiduciary duty. And so the question there is, well, can the board invest, and at what level of risk should they assume? And the answer is exceptionally low risk, right? You have a duty. This is not your money. But the same token, can we or should we take advantage of some of these interest rates or market opportunities out there? And the answer is that it is a possibility. Like, you're not stuck with minimal interest savings accounts. But when you start doing this, usually the person who's tasked with finding the investment tool is usually a board member or officer, and they're also coincidentally a financial advisor. And so this is just one of those flags. Again, I'm not saying this is where fraud occurs, but I am saying this is flag that could reflect the opportunity. And so should we maybe have internal controls there to make sure that if we are doing anything besides, money market savings accounts, that we have a very neutral party doing the decision making and a check and balance with the finance committee. Okay.
Is that not an instance where a board member would just need to at least let the rest of the board know that there's maybe a conflict of interest?
That's
Or
Yeah,
you know what I
that's-
mean? Where they say,
yeah.
I'm a financial advisor, I'm happy to help, but just so you know, this is.
Well, the answer is you're darn right it is, right? So so people typically think that conflicts of interest mean anytime that you have a personal problem, right? Typically we see the board member say, well, I can't vote to find my neighbor because she's my neighbor and I don't want to deal with that. Well, that's not a conflict of interest. A conflict is typically described in the statutes here as a director having a financial interest in the outcome of a contract or transaction with the association. And so if this director were receiving a commission off the investment of these funds, that is absolutely a conflict of interest. And actually we have a slide on that coming up, which talks about how we have to now disclose certain conflicts of interest and dealing with conflicts of interest, especially financial ones, and whether that has to do with, ineligibility issues for the board. And the short answer is yes. If you have a board member or an officer who is receiving any sort of financial commission or benefit or indirect benefit, yeah, it has to be disclosed. The general rule is don't do it. It just smells bad. It fails the smell test, and someone's going to claim wrongdoing, whether there's wrongdoing or not. So you might as well just avoid it. Maybe put that person on the committee, but put someone else, more neutral in charge of it. So actually, we'll talk more about fidelity bonds in a moment. So we can jump to the next slide.
Okay, I did have another question come in.
Sure.
If Michael asked if we have cash flow, which we do, can we loan ourselves money at an interest rate instead of going through a bank to pay for things such as insurance?
So this is the second time I've been asked this question, and I have a very smart not-for-profit corporation tax attorney in my firm, and his response was, technically this is possible, but the reality is that it's just not a good idea. And more importantly, it's going to result, and usually we're talking about reserves, loaning ourselves money from reserves. It's going to result in using reserves for unintended purposes. So either way, you're going to have to get a membership approval. Now, if this longer answer to the question, but if you're in an HOA and these are non-statutory reserves, I don't think you can actually loan those funds at all. It's not even an option because it's really just another way of having a rainy day operating account. But if you have restricted reserves or if you have condo reserves, these are technically reserve, these are separately segregated funds for different purposes. But you're going to have the same company owning both accounts. And so while internally you might be able to loan the money, I don't think you can actually have an arm's length transaction to make it happen because it's ultimately your same, your left hand, your left pocket and your right pocket. It's just that a reserve account in some instances has some restrictions on it. And so internally you might be able to have some paperwork done, but you're not going to actually be able to have a loan, certainly not for higher levels of interest to pay yourself.
I've got one more question that just came in by Brandy. She says, does a property manager need to disclose an affiliation to a vendor? If yes, to board members or the entire ownership?
It depends, of course, your favorite answer. And the answer is typically no. And here's why, because normally the manager is not on the board. All right. If the manager is not on the board, then they don't have a financial interest in the actual outcome. Now, there are separate code requirements for ethics and behaviors of licensed community association managers, which I'm almost certain requires the disclosure, which is why if you look at your management contracts, most of them have affiliations with some, whether it's a handyman company or a restoration company, these synergies are helpful. But in those contracts, they disclose those potential relationships. And so I think at a minimum, there needs to be some disclosure. Now, if the manager is the second cousin of the sales rep who doesn't own any amount of the landscaping company, I don't think that's a conflict, right? But if your manager is married to a 20% shareholder of the cable provider, right? Let's say they own 20% of Comcast. Now you're shoving Comcast in front of the board. Yeah, it's probably something that should be disclosed, certainly from the ethics side of the CAM. From the association standpoint, if the manager doesn't have a vote, it doesn't fall under the 718, 719, or 720 provisions for disclosures. Good question.
It is a good question. And I have to say, from a manager's perspective, or from when I was on site, I say more transparency is better, because if it comes up, it may look like you're trying to hide something. So if your cousin is the owner, you could say, my cousin is the owner, but I'm giving you 3 bids. And ultimately, the board signs the contract. Or they should be, right? If they're not, a board member should be signing your contract.
Absolutely correct. And usually the situation is a non-owner relationship. Often you'll have the manager's brother, again, works for the accounting firm, but is not an owner of the accounting firm. So do they have a financial interest there? The answer is probably not. Right. The answer is probably not. It's probably not a problem. But again, if your dad or your mom is the 100% shareholder of the janitorial company, and you just put in front of the board a janitorial contract where your mom or dad owns the company, like, that needs to be disclosed. But then when the board goes to approve it, the board doesn't have a conflict of interest, but you better darn believe someone's going to find out, right? You should never assume that's going to be quiet. And so you err on the side of disclosure, because these are high school's politics that it will come out.
Good way to put it. Yep.
So this is really self-serving, so I apologize. But what do you do if you suspect fraud? Well, probably should call the attorney, right? Because the attorney very unlikely has any opportunity to commit the fraud. And so that should be the first point. Now, a lot of our clients say, we only want you talking with the president or the manager. And the secretary says, well, I think the president or the manager are the problem. And so in that case, you have to kind of circumvent that policy. And as long as it's in good faith, if it turns out it is vindictive and malicious and defamatory without any basis, I would say that requires some sort of response to the board afterwards if you incur fees with the attorney to investigate something like that. But if you have a good faith need to report something like that, I can't imagine a board ever saying, that's improper for you to go around our back and ask for help on that. And so again, there's a line somewhere, I don't know where it is, but maliciousness, has no place to kind of go circumvent and try to stir the pot like that. We see it all the time. But when you have a good faith, bona fide reason to want to make that inquire, I don't think anyone would question or have a concern with you doing that. Request financial records. Again, this is asking for redundant sets to the extent that it's possible. If you have an audit being done, guess what? They're going to test your financial safeguards. That's a good thing. You can direct your management company, your CAM, to add board members as signers in all bank accounts and request bank statements. So we just heard that Castle does that as normal operating procedure, and that is good, right? You don't want to have management companies having any of them having unfettered check writing authority. And as we saw in my fraud case, that manager didn't have check writing authority, but they had a stamp of somebody who did. So make sure we know who has those stamps. And the last point is talking about the commingling of funds, but also, to my point before, making sure you update those signature cards. Don't just tell bank who the new signors are. Tell them who's no longer a signor, because that just creates more opportunity for fraud. Okay. All right, next slide. All right, we're going to briefly touch on insurance. I'm going to talk about the 2 statutes that deal with bonding and insurance for fidelity coverage, and then we'll jump down to some of the new statutes. And we're doing great on time. So the first one is that there are lots of different riders in insurance. There's employee dishonesty, there's computer fraud, forgery and alteration, social engineering, management company riders. If you talk to your broker, it is important to talk about what's covered and what's not covered. And if person X steals, whose insurance covers, right? If it's the treasurer, whether is it the insurance, is it the corporation, the association's insurance that covers? If the manager steals the manager's own funds, is that your problem? Or if the manager steals your funds, what policy covers that, right? It depends on who has the coverage and who is the bad actor. And so it's important to know this. Everyone thinks, oh, we have dishonesty coverage, but that might only cover your people stealing your stuff. And so there are other actors, there are other players that touch your finances. And so you maybe want to kind of think about who touches our accounts, who touches our checks. Now let's talk with our broker and says, here's the coverage we have. Are these people, if these are bad actors, do we have coverage to make us whole, or do we have to rely on someone else's insurance to make us whole? And if we have to rely on someone else's insurance, let's go take a look at it and ask for it. We shouldn't take it for granted, right? Is there a provision in that policy that requires notice of 30 days cancellation? All right, you'd want to know if that coverage is being canceled. And so the point here is we'll talk about the levels to set for insurance and fidelity bonds, but the bigger takeaway is that most of my clients don't actually understand what coverage they have. And their whole, in my experience, insurance companies don't exist to cover claims, they exist to deny claims. And if that's true, that's why all these riders exist and exclusions. So why would you need a computer fraud rider unless computer fraud may generally be excluded from coverage in your general policy? So if you only have the general policy, do you have coverage for computer-based fraud? So have the conversation. There's no bright line rule here, but understand who touches your finances and talk to your broker about whether, if there's a bad actor amongst any of those people, who covers what. Right? The next slide is going to talk about those actual coverages, and this will surprise people. This is chapter 718. Laura, this applies to whom?
To whom? You. No.
Condo, right?
Yeah.
This is the condo statute. And it says here that the association, a condominium association, shall maintain insurance or fidelity bonding for anyone who controls or disperses funds. Now, here's the amount. It must cover at least the maximum amount that will be in the custody of the association or its management agent at any one time. So think about, all right, when during the year, probably right before you pay your exceptionally large insurance premium, what is the largest amount we're going to have in our bank account that year, including reserves? And that's the minimum level of coverage you need to have. That might be $200,000. That might be 20 million for some of you. Okay. Persons who control or disperse funds include people who can sign checks, the president, secretary, treasurer. Okay. And the cost of this bonding is a common expense, right? This is not shoved off on the actual individual. This is a common expense of the company. Now, 720 is for our HOAs, right? Chapter 720 governs HOAs. If you see me in Publix, just say, hey, condo. And 720.
That's easier to say than HOAs, by the way.
Yeah. It's if you go back for 1 second, Laura. So the condo statute kind of says this is mandatory. All right, now let's go to the HOA slide again and note that until a couple of years ago, it was optional. Now for HOAs, it's mandatory and you can opt out. What I mean by that is that for an HOA, you likewise now says you shall have coverage for these people. And it's basically the same coverages and the same people and the same common expense. But an HOA can actually back out of some of these bonding requirements. Is it a bad idea to opt out? Yeah, probably, right? The cost is actually exceptionally low. And if it turns out you didn't pay the $200 for the bonds and someone stole $200,000, that's uninsured. That's a problem. Okay. So next slide. All right, great. So we're going to shift a little bit away out of practical tips and tricks for fraud prevention. And we're going to shift over into some of the most recent legislation, which kind of addresses this. The first one is probably news to all of you, and it's called the Corporate Transparency Act. This is federal legislation. It's not state legislation. And it was adopted, I believe, 2 years ago or 3 years ago, but ultimately it goes into effect January 1st, 2024. It is intended to address fraud and money laundering. And ultimately, it requires entities to make certain reporting requirements to the federal government, to the Department of Treasury. There are a number of exceptions. Unfortunately, they did not include condominium and homeowners associations. So the big takeaway from the first line is that the Corporate Transparency Act applies to you. It applies to every condominium, co-op, and HOA in the state of Florida and probably the country. You all are reporting companies. And somehow the rest of that slide, that sentence didn't get there. But what it's supposed to say is all reporting companies must disclose certain information on or before after January 1st, 2024 each year. So after January 1st, 2024, so starting next year, sometime during the year, you have to start reporting, and you have to report every year to the Department of the Treasury. Violations can result in pretty significant civil and criminal penalties. Some of the information that must be disclosed, you must disclose the corporate name, the corporate fictitious name if you have one as well, the address, jurisdiction, the tax identification number, as well as, this is the tricky part, the name, date of birth, U.S. address, and driver's license for each beneficial owner. Now, our firm does a lot of webinars and providing education material on what this means, and so I'm happy to provide that to you separately. But each beneficial owner has to disclose this information. Now, who is a beneficial owner? A beneficial owner is someone who owns it or controls at least 25% of the ownership interests. That's not usually the case for any of you unless you control or own at least 25% of the units. Or if you exercise substantial control over the reporting company. Now, it's kind of like saying reasonable control. What does that mean, Steve? And the answer is, I don't know, right? We have some guidance from the federal government, from FinCEN, but ultimately the question of what is substantial control is something that's going to be debated. Our takeaway right now, as it stands, is that based on the size of our communities and their boards of directors, all of the directors are going to have substantial control. Because they have an equal vote. Certainly the president and treasurer, probably the secretary. Sometimes you have a treasurer who's not a director. That person probably has substantial control. And even if you're not in those roles, right, there's guidance from FinCEN in the larger corporate context that says if you're the CEO, but you're not on the board, maybe you also have substantial control over the company. The other big question that we're going to be walking into is, well, what about in-house managers and management companies? Do they exercise substantial control? They're not on the board, but some of these companies have substantial influence. Some of the managers on the ground, whether you're in-house or with a management firm, can spend tens of thousands of dollars without going to the board. Is that substantial control? And so we're going to be learning a lot of answers to these questions over the next year. There is no prize for reporting first. All right, that's clear. There's no prize for finishing or reporting first. So most of our associations are probably going to wait until the later end of next year. It's entirely possible they will exclude condos and HOAs before then, but as of right now, you're going to have to comply with this. So every year you have to disclose this information. It's not as simple as filing an annual report on SunBiz, which you also have to do every year, and that's due by May 1st. So we think moving forward, most of you will probably be filing with the Department of Treasury around the time you're filing your annual report, because most of you have your elections in the spring, and the timing will line up so that you can timely file your annual report and timely file your FinCEN requirements under the Corporate Transparency Act at the same time. Now, here's the real kicker, is that you likewise need to file an update within 30 days of any change in substantial control. So how many of you out there have had a board member resign, pass away, move away in the last year, in the middle of their term? And probably all of you would raise your hands. Well, this new Corporate Transparency Act requirement says that if someone resigns, you have to tell FinCEN within 30 days. All right, that's a big problem. And what about adding new people to the board? And then you have to likewise update within 30 days people who have substantial control. This might indicate that some of you will wait to fill vacancies until the next election to avoid having to file that second update if you don't fill the vacancy right away within those first 30 days. It also means that you might have some people who refuse to serve. All right, we talked about ineligibility criteria and the list of ineligibility factors. Well, guess what? This is not on there. Refusing to file with FinCEN is not on there. I mean, you can't restrict someone from serving on the board because they refuse to report. But if they refuse to report, it could be deemed a willful refusal to comply with the Corporate Transparency Act and result in fines and penalties. So we're going to learn a lot more about this. We are hoping to be a resource for everybody in the state on this because we have a task force that's nationwide dealing with the Corporate Transparency Act. But the takeaway here is that if you haven't heard about it yet, you will. You are subject to it unless there's some change in the legislation, and that all condos, HOAs, and co-ops are going to have to start reporting this information starting January 1st, 2024. It was intended to address our topic today, which is fraud and money laundering. But ultimately, it's just another thing you're going to have to do, another thing you have to file.
And Steve, when would we know if HOAs and condos are not going to be a part of this?
Well, I can tell you, we would tell you right away, because that's big news, and we are keeping our ear to the ground very closely on this one. But today, the statute and the guidance from the Department of Treasury says there's no exception for us. So
Okay.
unless you hear otherwise, we need to assume that we had to file in 2024.
And is there a cost to filing? Do they charge? You know?
Like anything else, we would anticipate that most of our clients would not want to do this themselves. So our
Right.
firm is actually partnering with a third-party provider who is going to be doing this. And so the actual filing procedure will probably have a fee associated with it if you use a third party, and most of you probably will, at least to start off with. The question, however, is going to be a case-by-case basis as to who has substantial control and who has to file. Obviously, if you exercise good faith and you make a mistake, you would assume that there's some sort of carve out for penalties and fines and felonies, frankly. But are we going to take that risk? And so we do assume there's going to be a lot of discussion, especially in our larger organizations who have multiple layers of committees and decision makers and management involvement as to who in that is exercises substantial control. Because the kicker here with management is that if your management firm is a controlling entity, we don't disclose who the manager is. We have to disclose who owns the management company. And so we also are thinking that, but again, it's probably a very, very small percentage of managers who have actual control. So it's probably a very small subset of people who are going to have this problem. But we do foresee people talking about their management contracts and saying, well, maybe we should, revise this contract, make it clear that we don't have control, and to make it clear that we don't make decisions, and that maybe we can only spend up to like $200, and that's not control. Right. And so that we can clarify that there is a separation here of control with management and the board. But we do think, a board of 3, 5, or 7, yeah, all those directors are going to, have enough weight where they're going to be exercising substantial control. If you for some reason have a board of 25 people, maybe only the officers there have substantial control, or sub-executive committees, but most of boards of 3, 5, or 7 are going to be deemed to have substantial control.
Okay. Thank you.
So that is you were going to be hearing more about that. So the most recent legislation effective October 1st was really only, I shouldn't say only, but it was targeting 724 HOAs. And this came out of the Hammocks bill, as you may have heard of it as, which was a lot of shenanigans over in the Kendall area. Ironically, my in-laws live in there. They are smart enough not to be on their board of directors, but they were, they are residents of this larger community association that has something like 20-something sub-associations. And it turns out that, directors had invoices from their brother's mechanic company. And there's just a lot of stuff going on that involved payments to related entities of board members and officers. And this now creates a crime, right? It now dictates it is a crime to be involved in the forgery of ballot envelopes or voting certificates used in an HOA election. I guess if you're committing fraud, you want to stay committing fraud and the ability to hide your fraud. And so maybe you're more likely to falsify signatures and envelopes and get that election result that you want. And so this is now a crime. Theft or embezzlement involving funds. I guess you would say duh, but yeah, that's a crime. Destruction or refusal to allow inspection of official records in the furtherance of a crime, and the destruction of official records is likewise a separate criminal act there. So don't hear me say that if you don't get access to the ledgers within 10 business days that now they've committed a felony. That's not what I'm saying. I'm saying that if you are committing a crime separate from the destruction or concealment of official records, and you are likewise doing that, it is a separate offense, and it's going to be considered obstruction of justice in another way of criminal infractions. Next slide. New, it is a misdemeanor of the first degree to conduct fraudulent voting activities. So this kind of plays off of more of the slide that you just heard. This is likewise 4720 HOAs. This would involve falsely swearing an oath. And what this usually means is I swear that I sent those ballots out to everybody, but in reality, I didn't. I just forged them myself. Perpetrating or attempting to perpetrate fraud in vote casting. Preventing member from voting as intended or changing their vote. That makes sense. Menacing, threatening, I spelled threatening wrong. Menacing, threatening, or using bribery or corruption to influence, deceive, or deter. Right. So who knows what that looks like? Maybe it means canvassing and standing outside the HOA election booth and, being aggressive with people, giving or promising something of value. That's a kind of a no-brainer. Violence or intimidation to induce or compel members to vote or refrain from voting. Some of my clients, one of them actually said, hey, can we offer drink coupons at the bar for when people vote? I said, it's a great idea to induce participation. But now this might be deemed, maybe some sort of improper act. So most of this seems nonsensical to us who don't do this stuff, but obviously this happens, and this has been out in the state. And so now we have more definitions of what is a crime with respect to voting, because that's how you stay in control. That's how you keep doing the fraud, is by staying in control. This one is probably inapplicable for a lot of you, but this is 720. This is HOA. It's a new statute. It talks about commingling deposits. So really what this is talking about is if you take, let's say, $1,000 deposit from a member when they build their pool, this is effectively saying that we have to keep it in a separate bank account, and there must be a certain mechanism to return it to people, right? What happens a lot of times is they just shove it in the operating account and it gets lost. And next thing you know, it's another way of people siphoning off some of that dollars without the proper reporting. So this is intended to keep those deposits separate. In some of our larger communities, or in communities where there are environmentally sensitive building requirements, the deposits can be substantial. And so this is really what this is trying to address here. It's not trying to address the $100, in case the contractor, hits the gate arm, but this is really intending to get those larger deposits. Next slide. Again, this seems like a Steve, why are you telling me this? But this was added to the statute. An officer, director, or manager who basically takes a kickback is subject to monetary damages. All right, again, this seems like a but this is intended to say, well, if the director is in fact in a conflict of interest or in a precarious situation where they're taking inducements, then it's a civil remedy. There's a civil action. We different management firm altogether, but we recently saw after Ian, a restoration agreement where the manager signed it without authority from the board, and on the bottom, it handwritten, it said 3% management fee, right? And so the manager had negotiated for him or herself a substantial management fee of $1 million of contracts to bring this provider in. It turns out that the same provider was in 8 different communities that this manager was also managing. It was, again, a very small company. And so this was a problem. And this kind of goes back to earlier, where I'm not saying small management firms commit fraud. I'm saying that there is more opportunity there than with the larger organizations. And that's what we saw. And so that act under this statute now would create a civil action. Now, the situation I'm actually talking about was a condo, which is a different statute altogether. But if it was an HOA, this is now directly added to the HOA statute.
That's a good thing.
Removing directors from office due to bad acts. So the HOA statute actually provides a few instances where a director is deemed to have vacated their seat, meaning when they're on the board doesn't have to vote to remove them, but they are automatically removed from their seat if they are charged or indicted with any of the following acts. Again, this is the election fraud, forging documents. We forge documents and ballots to stay in power, to keep doing what we're doing. If we are charged, right, this means arrested, not necessarily convicted, charged with theft or embezzlement involving association funds, destruction or refusal to allow inspection of records in the furtherance of a crime, okay, or obstruction of justice. And so if you have a board member who is, again, charged with information or indictment, which is different from conviction of a crime, then they are deemed to have vacated their seat. The idea is we're not going to risk more potential negative consequences. We're going to take the risk that they maybe didn't do it, but get them off the board to be conservative. All right, next slide. So this is more 720, 720 HOA. Directors and officers, does not say manager. Directors and officers must disclose any activity that may reasonably be construed to be a conflict of interest at least 14 days before voting on an issue. Now here's what we have. There's a rebuttable presumption, right? So this is not an exhaustive list, but there's a rebuttable presumption that there is a conflict if the director or officer or a relative enters into a contract with the association. So if I'm the treasurer and I own a financial services company and I have the board sign a contract with the financial services company to invest the reserves for a commission, that meets the presumption of conflict of interest for under the statute. It doesn't say it's illegal. It says it has to be disclosed at least 14 days in advance. There's also a presumption of a conflict if the director or officer or a relative holds an interest in a corporation. So this is the indirect way of saying, well, you might not be, let's say Steve owns Steve's Landscape Company, right? Section 1 here is intended to say a contract between the association and Steve to mow your grass. The second one is where Steve owns 30% of Steve's Landscape Company and you hire Steve's Landscape Company. So the idea here is promoting the disclosure of conflicts of interest so that it is on the record that there is this disclosure. Again, it doesn't say it's prohibited. It says that you must disclose any activity that reasonably may be construed to be a conflict of interest. And you got to do it well in advance of signing the contract to give people an opportunity to sniff it out. All right, so before we get into some questions, and again, I'm open for any question you have, some takeaways. Consider job rotations. Okay, if you have the ability to request job rotations in the back office finances, who deals with your finances? Opportunity. Consider adopting a voluntary code of conduct. From a heuristic standpoint, when we commit to something in writing, we're more likely to do it. If you have a board member, you should maybe have an open policy that if you suspect fraud, you're authorized to contact the board. But if it turns out you're being malicious or slanderous, then maybe there's some repercussions there. Be cognizant of people living beyond their means and financial hardship. If possible, try and get some redundancies from the bank accounts. Review insurance coverages. Again, there's lots of riders and there's lots of exclusions. You don't need a rider unless you already have an exclusion. So talk with your carrier, your broker rather, about who touches your money and what policy would they be covered under if there was a bad actor. And communicate the need to disclose potential conflicts of interest. 718 for condo has a similar statute about disclosing and having fair and reasonable conflicts of interest agreements. But UCL was just added to 720. And so that's why we were highlighting it as a new statute. And the takeaway, which is not on here, is just be cognizant of the Corporate Transparency Act that will impact you in 2024, either in having to file something or sign relief, and that maybe there was a change to the statute saying that you are excluded from having to file.
All right, now we get some more questions. Been
Sure.
reading through some of these. All right, so Dennis asked, our bank statements read our association name, care of, property manager name and address. Is our money under their control or the HOA?
Well, your lawyer's favorite answer is it depends. I would call the bank to confirm, but that indicates to me that it is only being mailed to the manager, but it is in your name. That indicates to me it's only being mailed to them, but each institution may handle that a little differently. So I would call to confirm, but that indicates to me that's only being mailed there.
All right, Dana asked, our HOA just sent out proxy for clubhouse renovation for $2.3 million. They state that owners may drop off proxy in ballot box, use an attorney electronic voting, and also email their filled out proxy to the GM. Isn't email of attached proxy illegal in 720?
No. So 720 says owners may vote in person or by proxy. And there are some electronic communication statutes. Now, what you can't do is you can't email the board and say, I approve, and type that, and then click send. That is not the same thing as voting by proxy. What you are allowed to do is sign it with a wet ink, with a blue pen or whatever, scan it, upload it, and then email it as an attachment. I would accept that. Now, there's a little caveat here which could create a wrinkle, in that some of the older bylaws say that the original must be hand delivered to the secretary in advance of the meeting. And that's quite archaic, but emailing a proxy with a wet ink verifiable signature scan to me is not improper, but simply typing in an email, I approve or I reject, and clicking send is not the same thing.
Right, thank you. And Armando asked, is there a penalty to a board of directors for not providing a remote connection for annual meetings?
No. Good question. And as we came out of the pandemic, this is a question I ask all the time. And asked another way, Are we required to provide remote participation? The answer is no. The statute does not require you to allow or provide a mechanism to guarantee people can Zoom in. If you want, you can still say there's chairs in the clubhouse and it starts at 7 o'clock. We'll see you there. Now, the big T word, transparency, is used a lot, and most people will argue that because it's so easy and inexpensive now to do this, why not? And I can get on board with that. But it would not be a penalty for failure to provide a mechanism for owners to remotely participate.
Thank you. All right, last question right now. Karen asked, are there comparable laws for COAs that address these areas covered in the new HOA laws?
Yeah, a great question. And I kind of hinted at that. And the answer is yes, they're a little different. The condo statute has fluctuated more. We typically have more shenanigans in condos than we do in HOAs. And so the condo statute has had some knee-jerk reactions. For example, maybe, I don't know, 7, 8 years ago, the condo statute was changed to say that you can't enter into a contract with anybody that has a director or anyone within the 3rd familial degree of familial relationship with a director, which means if my 3rd cousin owned 1% of Pepsi stock, we can't get Pepsi in the cooler, right? So that statute's kind of been altered and kind of done away with. The 718 still has conflict of interest statutes where there are disclosure requirements. There are approval requirements that have to be, where the contract has to be approved by uninterested directors. It must be fair and reasonable, and it has to have a veto mechanism by the membership at the next annual or special membership meeting. And so, and there are also in the condo statutes mechanisms for removal of directors for certain financial crimes. So the answer is yes, they are not identical. They are a little different, but the most recent legislation a couple of days ago, October 1st, was really focused on that hammocks law, which is generally going to be looking at 720.
Awesome. I think those are all of our questions. What a great discussion. I did want to reiterate, we are going to post this, if you're okay, Steve, as part of our webinar.
Of course.
All right, on our website, you can go to www.castlegroup.com and we will post this recording. It should be available in the next 24 hours. Usually it takes 24 or 48 hours. And then Shauna and I will be emailing out a link to this webinar, so you can contact Steve if you have any further questions or want to connect with him on any topic that he just spoke about and pick his brain some more. But thank you guys so much for joining us. Here another, let's see if it's a question or a comment. Okay, this is somebody who said our HOA did get fined by the local Fair Housing Authority because of a homeowner filed a complaint against us for not having electronic meetings.
If you are subject to certain fair housing laws and an owner requests a reasonable accommodation to maybe themselves attend remotely, that might be an issue. But it depends on whether you're subject to ADA and Fair Housing Act. But the statute 718 or 720 does not mandate that you allow remote participation. It authorizes it, but it doesn't mandate it.
All right. Thank you for that last minute question and for answering that, Steve.
Thank you again, Steve. Great.
Yeah, great information. And we'll keep listening and hearing from you. And I know we'll be connecting with you early first of the year for some educational opportunities, and we may have more information.
Thanks so much.
Thank you. You guys have a great day.